Starting off with the Nairobi Securities Exchange, we're on a bit of a rally. It's not overstated, it's not dramatic, but the NS is touching new highs every day.
I believe this is actually being pushed by foreign investors, because when you're looking at the counters for the last 2 days, we've seen that Safaricom, Equity, EABL, Barclays Bank, foreign participation has actually touched over 90% of this. And we see that local investors are actually coming out of the market for reasons that many of us are actually speculating. Why? Because this is the perfect time to actually get into the market. So for for supply to actually be given by local investors and for demand to actually be controlled by foreigners is actually, okay, it's good for the market. It's actually pushing up the numbers. We've seen that we've seen that foreign investment confidence in the country is actually picking up. But in terms of local investor confidence in our own business is actually worrying, because now this shows that a couple of issues are making the local investor actually divest from it.
But yesterday, 59% of trades was controlled by local investors, not the foreigners. Though that said, about the most of the interest from the market came on Safaricom and Equity, and these accounted for 90% of demand. In
terms of our supply, everything was actually controlled by local investors. Yes. But in terms of demand, when you're looking at, for example, Safaricom trades, 98.7% was accounted by foreigners, Equity Bank. So we were able to see that, but we were able to see that foreigners, I think because they have access to better information, and like, for example, Safaricom just about to close its book so they can announce a dividend payout. And also we're trying to see that foreigners actually appreciate the essence of consolidating around Safaricom shares because of the good, strong fundamentals it has in the market. So it's a small mini bull run, and I think if this continues, we'll be able to see that in the coming weeks, maybe the market can actually touch the 4,000.
3,941. We're very close. Maybe a few more days.
A few more days, and it'll be at 4,000. I mean, it's possible given the demand of particular stocks. We're looking at Equity, we're looking at Barclays, we're looking at our Kenya Commercial Bank, and this is all being driven by key fundamental factors that these actually companies have.
All right, let's stay with banks for just a little longer. Safaricom and Equity Bank obviously dominated trade, but CFC Stanbic Rights debuted trading at the market yesterday, but the share itself did not do too well.
This is because, when you look at how the entire market has been, there have been too many rights issues in the past couple of months. We've been able to see that in local investor confidence, especially in this aspect of banks using rights issue to raise money, is actually dwindling.
Right.
So for this, in as much as we'll see a lot of fund managers and a lot of foreign investors taking up the rights issue, we're able to see that this share will actually take the hit in terms of its performance, and it will be a while before it can actually balance out, because when you look at the performance of CFC in comparison to other stocks, right, it's actually dropped 11%.
So is it the fact that the market is almost starting to get tired of rights issues, and CFC Stanbic is almost like the guinea pig, the first one for which the interest is not that much guaranteed? Or
I mean, when you look at it, rights issue benefits majority of preferential shareholders of the listed firm.
Yes.
So we're able to see that the benefits of this actually now, many local investors are getting tired of this, and they're looking for other alternative avenues. And we're looking at a means where you can actually be able to put your money to be able to make some profit, where you beat inflation, or be able to get something above the normal interest rate. So yes, the need for looking for capital raise for banks through rights issues actually coming to an aspect. It's actually reached its optimum.
So still on banks, after the central bank's surprise rate cut 350 basis points, now banks are reducing their rates. Maybe the most dramatic I have seen is housing finance from 23% to 18%, but we have Barclays and KCB and all these other banks making the movements in that direction.
The Kenya Bankers Association actually issued a statement saying that it will be a while before banks can actually be able to factor in the changes that central bank actually did give.
Yes.
Giving out a myriad of reasons, say one, that it will be a while before they can readjust that.
Because one of those things is the statement, for instance, out of Barclays is from October 1st. We're in September, so that's almost 2-3 weeks away.
Exactly, which means, I mean, for me as a borrower, I don't think banks are actually being fair, and I don't think banks will actually do any dramatic drop in terms of the lending rate from the 20 digit to 1 something. Because yes, when you look at, for example, it's only Barclays and KCB that have reduced, but when you look at the reduction, it's very
marginal, isn't it? Because the central bank rate is at 13%. The average rate right now appears to be around 19%.
With many analysts actually saying that we shouldn't really be excited about the drop, because many banks will be reluctant to drop below 20. And this is because, one, they're all looking at the loan portfolio performance, they're all looking at the interest, they're all looking at how, before anyone can actually reduce significantly, they'll have to come up with a strategy to be able to bring in more customers, to be able to boost the deposits, to be able to recover. Because at the end of the day, what they're paying out in terms of deposit interest rates is also high. So these are the key issues that are going to look at it. And I think for Barclays to be honest and say that they'll consider this 1st of October, other players in the industry are actually being watched. NIC, especially NIC, coming up with its rights issue, which should be closing in another 5 days.
You know, this brings up that old discussion about whether the central bank and the members of parliament have tried to do this, to put a cap on how high banks can go above the CBR, and the suggestion then was 4%. So ideally, no bank should be charging interest rates above 17% right now, if that were in place.
The arguments are pro and con, because one, the Kenyan market is liberal. So for you to be able to actually put up a cap on it, you'll actually be saying that now we'll control how you make your profits, you'll control how you do your business, you'll control how much money you spend in terms of expansion and cost of operations. However, on the other hand, when you look at how the central bank has been able to deal with inflation and the stabilization of the shilling, and just basically being able to make access to credit easily, banks are actually going above board in terms of, they're being, allow me to say, being greedy a bit, because, having a bank charge 10% more than what central bank has actually said is actually being a bit too greedy. But now you see, these are issues that bring in the element of legislative framework, which must be enforced by parliament, and I think a lot of more discussions need to go into play.
You know, when you said banks are being greedy, it reminded me of a line from the movie Wall Street 2, Money Never Sleeps, where the main character says, a few years ago I said greed is good, now it seems it is legal. In this case, it might be. But let's move on. I was trying to not talk about this, but we have to. Kenol Kobil running into even more trouble. Now the pipeline wants 2 billion shillings from 2009. The employees don't want the Puma takeover deal to go. It just reported an almost 4 billion shilling loss. What good news is there about Kenol Kobil?
First, you must understand that a takeover has now happened in Kenya, especially for a listed firm. So Kenol Kobil is going through, it's setting precedent, and it's going through uncharted waters. I believe there are a lot of skeletons in the closet for it. I don't think the deal will go through as anticipated, but I think if the Puma people are patient enough, they can go through if they're willing to set out issues. We've seen a huge loss of 3.9 billion. It's local, especially its key local investors accounting heavy losses. And I think given the hue cry from employees and local retail investors, the minority ones, the capital markets, it's time for the capital markets to actually come into play and try and enforce a few, because I think the legislative framework is a bit clear on a few of these issues. And I think most of these issues have not been followed per se.
Some reports saying Puma is expected to finish its due diligence on the company at the end of this month. There's even talk that it might be a hostile takeover. So all sorts of interesting things.
You see, for you to be able to announce a takeover in the first place without really doing due diligence is actually tells you a lot about how our Kenyan market is in terms of acquisition and mergers. And you're able to tell that in as much as Puma wants to close the deal badly, the interests of the state, the interests of the investor, which are supposed to be protected by CMA, are actually going to come into play a lot. And we're seeing that the moment the judiciary steps in and start, preventing the sale from going through, it's going to get into murkier waters.
And speaking of the CMA, very quickly, the Capital Markets Authority is currently without a substantive CEO after Stella Kilonzo left. The finance minister has rejected the list of appointees that were presented to him, and he says they do not meet the bar, and it looks the process might have to begin again. Is there any cause for concern, the fact that the CMA does not have a substantive head? The
official response given by Treasury is because they'll have to wait for 5 more months for the CMA to be actually upgraded into a full status parastatal.
Yes.
But I think the undercurrent power play between the board. The board has actually been trying to exercise its muscles, trying to follow the law, trying to protect investors, and to play by the book. But we're seeing that Treasury wants to control things, wants to pick whoever must run the show. So we're seeing, the Treasury and CMA actually heading for
a showdown of sorts.
Yes.